ручка. Просто депрессия. Да, вообще не пишет. Ну, подожди, я тебе покажу. Посмотри. Be like... I like this. Но когда надо подпись ложить, она никогда не работает. То есть not so.
Этот случай, если такая
У меня тоже есть вторая, don't worry. У меня есть Walker Hotel, даже не знаю. Или с ресторана.
I biked and then they sent me to the...
Ты знаешь, что когда ты берешь таблички, ты прям потому что им надо таблички производить.
Well. Ну, мне когда...
Я смотрела Jared видео, женщина, которая живет на Zero. Она такая, я так ничего не
Слушай, it has to be all moderation, you know? When it's too much, it's too much. Там, как я тоже смотрю, знаешь,
Я тебе написала, да, что мне это нравится. Это неправильно?
Это?
Нет, это уже неправильно. Ну, до этого раньше не
Я всегда, да, не понимаю.
Вот это цветик.
Потому что похолоднее, лучше сидеть глаза, знаешь. Еще когда я был 10, God knows when.
У меня же мама голубые глаза и бабушка, мне не досталось.
Ага. А что, коричневый тоже хороший, у тебя коричневый, да?
А уже у сына коричневый.
Ай, ну.
Я все время прикалывалась, сразу говорю, будет блондинка с голубыми глазами. Такой стриптильный, конечно.
А что, знаешь, как генетика бывает вылезает? То есть, you never predict.
Да, родители.
Обе с голубыми глазами. Мама, не знаю, что эти цвета. Подожди, давай посмотрим quickly. Нет, no. Так. Ну я еще позвала эту, я не знаю, больше нам приедет, не приедет. Это Юлия, Наташа, Миранда, это все из Израиля, я тоже не знаю. Лора, мне кажется, она away. Джейсон Бланш. Ты видишь, они Бланш, Станлey тоже. СПС нашего клана. Так что I'll probably ask everyone tomorrow. Я тебе скажу.
Лучше бы с Black Rock пришла.
Так она вот с Джейсоном Бланш приходит. Я типа познакомилась в воскресенье, мы как были пошли на караоке. Не. Ну, они были знакомы. I joined them there. Sorry.
Уже ты говорила место?
Да. Зато когда они будут разговаривать или будут смотреть на нас, будет like, she's got a question. It's okay.
Why am I never in the office when you're in the office? I know.
Если вот эта девчонка где-то с штанами. А вот это сразу видно, что академия. Кто? А в школе?
В академии мало.
Да. Ну я не знаю, но знаешь, в принципе, это всегда вокруг таких лузеров. Да?
Я заметила, я даже когда нашла работу инженера, меня распределили в лузеров, которых не было образования вообще.
Да.
Ну, меня так сразу, знаешь, так, из-за того, чтобы improve, у меня так сразу потому что если бы мне дали отдельный кабинет, я бы устроила.
Да. Ты все равно знаешь, если ты всегда видишь, не знаешь, что ты такое, как одеваться, там знаешь, что ты на ее ботинки посмотри. То есть это Кларкс, наверное.
Удобно, что ли.
Вот именно, ну то есть знаешь. Я должна была пойти в Кларкс сегодня, поэтому у нас не choice.
Конечно, я не могу это назвать ботинками.
Ой, боже. Это одна вещь, которая мне нравится все, знаешь, development finance, impact investing, они все такие between non-profits, знаешь, making money.
Я вчера с одним девчонкой разговаривала, у нее Ребекка был раньше ректором у нас в ВУЗе.
Да.
Короче, он мне говорит, sustainability это настолько новая, говорит, наука, что она появилась где-то в 2009 году, ее только начали учить, и сейчас только еще 2 поколения перед тобой. Потому что у них всего 50 тысяч sustainable professionals in the world.
Oh, wow.
Так что говорит, ты, говорит, уже, говорит, специалист, что говорит экспорт. Когда идешь куда-то, говори именно экспорт.
Sorry?
Потому что позитив.
Okay. Holy
Нет, а что так есть, если посмотришь, только сейчас началось, знаешь, it's being very
Welcome,
sexy.
everybody. Thanks so much for coming this evening. Is my mic working? You all can hear me? Mm-hmm. Yeah, excellent. Great. Well, I'm Tensie Whelan. I'm a clinical professor for business and society here at Stern. I also run the Stern Center for Sustainable Business. Really pleased to have, let's just raise our hands. How many current Stern students do we have here? And how many Stern alums? Great. Excellent. I also want to recognize we have Rick Mayo-Smith here is on the Stern Board of Directors and also on the advisory board for the center and a great supporter. So thanks for coming here, Rick. We have a terrific panel for you this evening. Really, I think a really interesting topic and one that's growing in interest and focus and depth. We have in this country about $1 in every $5 invested in nominally in what we call ESG investing. So, and that includes within that whole sector debt financing and equity financing, venture capital, et cetera. And it includes a wide range of types of investing. So one of the things that I just wanted to point out as we have our conversation here today, that people often confuse the terms. What is impact investing versus ESG investing versus SRI investing? So just to make sure that we're all on the same page with the alphabet soup. So ESG, or let me start with SRI. So socially responsible investing started some decades ago with a focus on how we invest with our values and primarily started out with a focus on negative screens, right? How do I ensure that I'm not investing in oil or investing in tobacco or weapons or things like that. And then over time, that evolved into what we have today, a very robust area called ESG, environmental, social, and governance investing. And that is looking more proactively. You can include negative screens, but it's looking more proactively. What's the best in class, best in performance around performance on, and it could be the host of environmental, social, and governance issues. It could be just on certain types of environmental issues like climate change. So a wide variety of different types of strategies. And that's probably the largest area. And then we have impact investing, which is what we're going to be talking about today with this terrific panel. And impact investing is looking to see how you can, with your investment dollars, really ensure positive impact on a set of environmental, social issues that you as an investor care about or you as a fund care about. And so there you're investing in the types of companies that will really deliver impact. On the ESG side, you may be as well, but you're looking more, you could be investing in a coal company, but it's the best on ESG. You could be investing in a company that has nothing to do with sustainability, but has very good sustainability performance. Whereas in impact investing, and we'll hear great examples from our group here, they're really looking to say, how do we help to improve the quality of life for underserved communities or for water quality or a variety of different issues. So without further ado, let me say a few words about our speakers, and then we're going to have them talk a little bit about themselves and how they got here. So we have, all the way at the end, we have Humaira Faiz, who is with Morgan Stanley. She is Vice President for Sustainable Finance at Morgan Stanley and is also a Stern alum. It's really terrific to have her here with us. Then next to her, we have Rob Kaplan, who is with Circulate Capital, where he is the founder and CEO. Prior to Circulate Capital, he was with Closed Loop Fund, and I think we'll have some very interesting things to say to us. Then we have Swaminathan. Thank you, Swaminathan, who is on the private equity team at Developing World Markets and is also a Stern alum and is going to be doing our Stern talks to our 600 freshman class, which is very exciting. And then Jason Scott, who I've known for years and really thrilled to have you here today. Jason is co-managing partner and founder of Encourage Capital, on the board of directors of the company as well. He was also a founding director and investment analyst at Generation Investment Management, which is one of the first big funds started by Al Gore and David Blood, known more commonly as Blood and Gore. So let me turn over and start with you, Jason, and ask all of the panelists to tell us a little about yourselves, how you arrived at a career in impact investing, and what your company's mission is, what you're working on. Quick version. 3-minute version.
So my name is Jason Scott. Thank you. We have known each other for a while, and Tensie, if you're not taking advantage for being at NYU, you should. There's a lot, including investing. My background actually in not a direct path to this path. I took a year off of college to work on a presidential campaign, and when I graduated, I worked in politics for a couple of years. And when I came back, I helped start a nonprofit called Public Allies, which is a community youth development program. That was 1991. It was a long time ago, turns out, and still on the board of that nonprofit. And I think that kind of community development work and political work, community organizing work is kind of a big part of how I ended up where I'm at. Worked at Public Allies for a fair amount of time, and then my wife and I moved to London.
Thanks.
My wife and I moved to London, and I actually did a joint executive MBA program between Columbia and London Business Schools. We were in London. Like many business students, I was looking for a job. I'd been doing a lot of consulting work during college. During the business school program, like a lot of executive MBAs do without real jobs. And I got offered a job to be the first employee at Generation Investment Management in London. I had a background in software. I'd actually started a software company for a couple of years between Public Allies and business school. Left that part out and ended up working as an analyst for a firm called Flatiron Partners here in New York. Kind of Union Square Ventures is one of the subsequent funds of that. But so I had a little bit of investment experience and a lot of experience starting stuff. And so spent a couple of years as a software analyst at Generation on their public equities fund, and then helped start a private equity fund called the Climate Solutions Fund, which is now about to raise their third fund. But I left after we raised that fund to start a firm called Echo Asset Management Partners here in New York. I wanted to move back to New York for personal reasons, kids, in-laws, things like that. And some of the partners of Generation basically seed funded the launch of Echo so we could invest in environmental markets. After a couple of years of doing that, we merged our firm with the firm, the investment management firm of our largest investor, which was the family office of Jim Wolfenson, who ran the World Bank for a couple of years, and his son Adam and I managed Encourage Capital together. And we work across environmental sectors, across food, water, ag, seafood, climate and carbon, basically designing and developing, let's just call it for the sake of argument, impact investing strategies that generate some type of commercial return, but also have a systemic, we think, systemic impact on solving social and environmental problems.
Thank you, Jason.
What I miss?
I think you did a good job. Suma.
Hi, everyone. I'm Suma Swaminathan, and as Tensie mentioned, I was a Stern alum here. And my background a little bit is that I worked in technology, started my career there, ended up working in the handloom industry sector in India for a policy advocacy firm that was based in the southern region of that country. Then moved to New York for business school. And while I was here, I started focusing a little bit more towards impact investing. Graduated, worked in finance for a few years. I did complex asset valuation and startup valuation. And then more recently, I've joined Developing World Markets, which is also incidentally where I interned while I was at business school. And so at DWM, I work on the private equity team, and I cover Asia investments. So overall at DWM, we have investments across debt and private equity. And we started off mainly investing in financial inclusion, so microfinance, SME lending, affordable housing, all of that. And then more recently, we've moved on to thematic investments, including off-grid solar, water and sanitation. On the private equity side, still heavily financial inclusion focused. And happy to talk about that a little bit more.
Great, thank you. Rob.
Good evening, everybody. I'm Rob Kaplan, founder and CEO of Circulate Capital. Similar to Jason, I started my career in public policy and politics and did that for a number of years before I transitioned to the corporate sector. And I led environmental sustainability and supply chain investing in the beverage industry and then later at Walmart. I got into the impact investing world by trying to solve a problem that required capital as part of the solution. And so sort of backed into it that way rather than trying to develop an investment product first, looking for a problem. We created Closed Loop Partners and Closed Loop Fund, which I co-founded here in New York, and just recently, in the last 6 months, spun off our emerging market strategy. Our model is unique in that we partner with many of the world's largest corporations, which is really my background of Coca-Cola, PepsiCo, Procter & Gamble, Dow, and we partner with them to leverage their capital and their resources, their technical and supply chain resources to keep their waste out of the environment. And that has taken on a new life in the context of ocean plastic, which is increasing importance in many circles, especially in Southeast Asia. So that's where our emerging market strategy came from and why we spun it off as Circulate Capital.
Thanks, Rob.
Hi, everyone. Humaira Fez, as Tensie mentioned, I'm the Global Sustainable Finance team at Morgan Stanley. And a bit of background on me, I started my career in financial services. I was at Bank of America Merrill Lynch for a number of years, working in the alternative investments group, and really enjoyed the investment process and work, but wanted to somehow bring it closer to what I was doing in my free time, which was working on food and financial inclusion and other issues, volunteering on weekends and nights. In my head, I invented impact investing on my own, thinking that I could bring the rigor of what private equity managers brought to the social enterprise and nonprofit world, and then it turned out that that already existed. So I decided to go to business school to pursue a career in impact investing. While in business school at Stern, I held a number of internships in the sector. So I was at B-Lab and then the Rockefeller Foundation and OPIC. And when I was graduating, I knew I wanted to do something to see the entire sector from a more philanthropically oriented perspective. So I went to Arabella Advisors, which is a advisory firm focused on philanthropic investors, where I, at the end, led the impact investing team and got to suggest investments like Encourage Capital and Closed Loop and DWM to my clients. Now at Morgan Stanley, I'm on the Global Sustainable Finance team, where I sit at the firm level, really helping to deepen and expand sustainable investing strategies across Morgan Stanley's lines of business, so the wealth management, asset management, and institutional banking side.
Thank you very much. So here, you can come sit over here on this side. Come on. Come on down. It's easy. So Humaira, let me ask you to give us a sense of how you identify opportunities for investing in impact. Right? First of all, there's so many areas of impact one could focus on, right? Secondly, how do you determine that where you make that investment is actually going to result in in a positive impact along the lines of what you're planning for?
Yeah. So I think my answer to this will be a little bit different from the other panelists here, because my job at this firm level in Morgan Stanley is really to help provide our clients with all the options available to them that have gone through the rigorous diligence and institutional backing of Morgan Stanley. Specifically, for example, on the wealth management channel, we have 120 products and solutions that have been vetted in the same way that any other traditional investment product would be for the Investing with Impact platform, which is now $25 billion in assets and really focuses across public equity, public fixed income, private equity, private debt, and on different themes like gender diversity and climate solutions and faith-based investing, really to provide an open architecture where clients can decide for themselves what's most compelling and interesting to them and make their choices in investments.
Thanks. Rob, do you want to take that?
So when you're a fund manager, pipeline sourcing is your biggest challenge and your biggest opportunity. So our model is based on leveraging networks across the board, right? So we work with our corporate partners like a PepsiCo to say, where are you sourcing recycled material today and in India? Which of those partners that you already are working with need capital or would like more capital, or partners you would like to work with but need capital. So through our corporate partners, we also work very actively with environmental organizations that are operating on the ground, who are trying to develop projects that could one day be investable, and helping them build that kind of technical capacity within their networks. And then, of course, through other banks and lenders and other investors. A large part of how these deals get done is because of someone you know who's already looked at it and is bringing it to your attention. And we bring often a unique perspective of how our corporate partners perceive an opportunity. And that's of great value to our co-investors who say, we're looking at this, but would it work for PepsiCo or would it work for Procter & Gamble? So there's a bit of a sharing of value when you're working on a deal.
Rob, could you tell us a little bit about your theory of change? I mean, so a lot of the ocean plastics are generated in a certain area of the world, and what kind of opportunities do you see from a business perspective to invest in that? Sort of tell us a little bit about that. How do you choose those?
So a few years ago, there's a lot of research that was completed that found that more than half of the plastic that flows into the ocean comes from just 5 countries in South and Southeast Asia. So it's not really a developed market problem, it's an emerging market problem. In fact, I did a little bit of math. If you added up all the G7 countries and their marine plastic pollution, it'd be about 1% of the problem. So, that basically led us down this path of, well, we're talking about integrated waste management in these countries that have high plastic leakage. It's leaking because it's mismanaged, and how do you increase the management of that waste stream? And investment is a big part of that. It's not the only part. It's public policy and extended producer responsibility all fit into the mix in these markets, but we're trying to build that investment marketplace.
Thank you. Suma, if you could talk to us a little bit again around how you determine where you're going to focus, what kind of impact you're looking for, how do you ensure you have that?
Sure. Is it on?
It should be, yeah.
So I think usually what we... Hello?
There you go.
Great. So I echo everything of what Rob said just now in terms of pipeline sourcing. Co-investors is a big one, like-minded investors, as we call it in the PE world. A lot of times it's, we've been in the, at DWM, we've been in the financial inclusion space specifically for over a decade now. And so the networks is another big area where we find our pipeline, what types of opportunities to invest in. The impact aspect of it is a very interesting one, and one that's evolved as the industry has evolved, I would say. So when we started off back in mid-2000s investing in financial inclusion, where it was broadly microfinance, from that point on, I think now it's evolved into a little bit more of, well, within microfinance, how do you think about outreach? How do you think about responsible lending? Which of your investees subscribe to, say, the client protection principles? How are they implementing it? So there's a lot you can get into. The question is, how you go about doing that. And so for us, it's simple. It's about integrating it into our due diligence points, going into any of our potential portfolio companies, trying to assess how they're doing in addition to their financial performance, also assessing a certain scorecard that we prepare on their impact metric side of it, and then the follow through after that once you've invested in it. So I think overall that's how we think through our theory of change and more or less how we implement it across the life cycle of our investment.
Could you give us a concrete example of an investment that you made and an impact that came out of it?
Sure. Given that we are financial inclusion focused, a lot of the investments that we are looking at, we track, say, outreach. We track also responsible lending, so prevention of over-indebtedness. And then another important thing for us overall at DWM is catalyzing institutional investors towards the investment. So well, maybe I can actually talk about how we did it as part of our due diligence process, which is primarily to look at a company. We have an interview with them, talk with them about how they've done the outreach aspect of it, whether they're using any alternate delivery channels, whether they are able to, in their policies and procedures, whether they're talking about underserved markets. And in terms of an example where we have seen the impact come through, I mean, in each of them, we've seen numbers where I think our outreach for our overall portfolio is now 5x what it was at the time of our initial investment. We've also looked at what percentage of women are in the outreach. I think for our overall portfolio, depending on the region, it ranges between 70% women served, 90% women served, and then drilling down beyond that, going down into the portfolio company level itself, where as active private equity investors, when you have a board seat, how do you implement policies and procedures, senior management incentive schemes to align financial and impact goals?
Thank you. Jason.
Maybe I'll talk about the strategies. We have different
Yeah.
strategies. Talk about how we pick strategies. So at Encourage, we have 4 or 5 different strategies. Thank you. Thanks, Rob. So at Encourage, we have 4 or 5 different strategies, and that doesn't include some of the strategies that we've done research on and decided not to generate investment ideas or raise money around. Initially, at Echo and at Wolfenson, we developed our own investment products based on where we thought there was an opportunity. But when we merged the 2 firms together, part of the thesis was that we wanted to partner with asset owners, with family offices or foundations, even nonprofits or government, to do research around a specific social or environmental problem. And when you dig into that problem, figure out, are there commercial investment opportunities that Encourage could pursue? Are there commercial opportunities that maybe someone else is better positioned to pursue? Or are these problems that are better solved with concessionary capital? So program-related investments, below market rate returns, but still profitable investments. And then finally, are these problems that are better solved by just better policy or science or government intervention? So, I'll use one example. So this is one I spend most of my time on now, is sustainable seafood. We were approached by Bloomberg Philanthropies and the Rockefeller Foundation based on similar work we'd done around green infrastructure. And they said, can you take a look at this problem of the oceans and see if there's a way to profitably invest private capital in a way that they very ambitiously said, save the oceans and feed the world. But they did have 3 very specific outcomes: restore ocean ecosystems, provide jobs and livelihood for poor and vulnerable people, and to provide a healthy source of protein, especially for poor people. So they gave us a couple $1 million, which was a reasonable amount of money for us to build a team and go figure something out. And we spent 2 years doing research. You can see the research at investinvibrantoceans.org. It's a very cool website paid for with their money. And 400-page report, 50-page executive summary, 90-second video. Recommend the video. That explains what we're doing. And we really came up with we came up with 6 strategies. One of them was a blue bond strategy for the Philippines, which went up in smoke when Duarte was elected. So there you go, exogenous factors. The second 2 were a series of strategies that were focused on investing in small-scale fisheries using concessionary capital. And a nonprofit called RARE actually took that blueprint. They were one of our partners in the research. And they've raised $20 million for a fund called the Malloy Fund with concessionary capital, mostly from Global Environment Fund, a couple family offices and foundations, to invest in small-scale fisheries, mostly debt, with the a few intentional impacts and a below-market financial return. They wouldn't market it that way, but I mean, they are very clear. We're prioritizing impact over returns. And then we decided to go and try to put together a strategy that was focused on what we thought was a very specific part of the value chain, where we thought we could invest private equity capital in companies that were vertically integrated in Chile and Peru and the US and Europe, that we thought could use the money that we gave them to expand their supply in these regional kind of rural communities, build plants and processing facilities, and then also to develop new and innovative products to bring seafood to people in different formats. So we made 2 investments, one in a company called Fish People based in Portland, Oregon, another in a company called Geomar, which is in Chile. Chile is a shellfish company. Fish People's more or less a finfish company. You can buy both of their products on Amazon and a ton of places around here. So Geomar is mostly canned fish. We're actually acquiring a company right now that I can't name. Geomar is that does more finfish and kind of those pretty canned, glass jarred products. Fish People created a new meal kit, which you can buy at Whole Foods and a bunch of other places, which basically takes a pretty simple product and puts it in an exciting new format that they can charge more for. And then they've just recently launched 2 new products, well, they have soups and other things, but the 2 new products are a seafood jerky, like a protein snack, and then a packaged kind of flakes that you can put on salads and sandwiches. So it's very specific examples, and the point of those examples is that each of those companies is doing exactly what we said in the blueprints. And if we hadn't been able to find the companies and then find the capital, one of the Walton family members, who also is an investor with Rob, Ben and Luciana Walton, funded both of those transactions. Without the research, without the deals, and without the money, we wouldn't be doing seafood. So, and now we're building a broader strategy around those 2 companies, partnering with a much larger firm, which you probably have heard of, called KKR. So we're now working with them to buy much larger companies with exactly the same thesis.
Really interesting. So it's a very complex ecosystem as you start out. It needs a lot of research and support to get it going, right?
And then, you know, an interesting example, which is related to Rob, is we actually were hired by Paul Allen's family office, Vulcan Ventures, to do a report on oceans plastics. All these reports are on our website. And, you know, we came up with a few blueprints and ideas, and we went to Vulcan and we said, look, there's a lot of interesting commercial ideas. There's some concessionary ideas, and there are also some public policy things we think you should do. We're not actually, we don't think in a position to do any of them. We don't have, you know, EM waste management relationships. We don't know anything about the circular economy. We don't know a lot of corporates. There's a whole lot of reasons why we couldn't do it as much as we wanted to build a strategy. So we kind of put it on the shelf, and then Rob showed up. And actually, it's an interesting example because he has a lot of personally and professionally kind of the skills, relationships, experiences to say, hey, actually, I'm willing to go into emerging markets, willing to work with corporates, have the capacity to do project finance. None of us have ever done a project finance deal. We're equity people, and so we're helping Rob as much as we can because we're excited about the opportunity, but it wasn't a good fit for us.
Thank you. Rob, let me just ask you if there's sort of, based on that softball that was just lobbed to you, if there's anything that you want to add. And also, again, I like the, I like the way that, Jason, you just sort of went granular with us with some very concrete examples of types of investments. So if you could maybe give people some ideas.
And recommendations for products to buy.
Yes, you did. Fish jerky, next upcoming thing. Yeah.
So, as we looked at the investable marketplace, like where is the pipeline? That was really the first question as we started to look at this, and we leveraged what Encourage did in their report for Vulcan and other stuff. We spent about 5 months on the ground just trying to shake the trees to see what we could find. And there's basically 3 flavors of investment opportunity out there that we saw. There's really big waste to energy or incineration projects that are in the $100 million range, not really in our scope. There's sort of medium-size or small, medium-sized projects like recycling facilities that are probably in the $20 million range. And then there are a lot of startups, waste and recycling startups. So if you think about it as a value chain, you've got collection, sorting, processing, and then manufacturing, and then your end markets. The end markets being RLPs, the companies that want to buy that material. So an example of a company we're looking at is it's in India, actually. It's they have 3 lines of business. They originally got into the business by recycling industrial scrap from like Coca-Cola and PepsiCo. PET is what plastic bottles are made out of. And so they were recycling that product. They've now expanded into post-consumer collection. They run about a dozen post-consumer collection sites, a few of them directly, but they also have a franchise model that they're leveraging, and they're now trying to raise about $10 million because they want to triple the amount of post-consumer collection in their business. And then they have a third line of business where they actually are creating recycled content products like T-shirts and selling them back to Coca-Cola, for example. So that's an example of a company that could potentially scale. They're looking to raise capital. They haven't raised a lot of capital to date, and there's not really anybody in the space who's talking to them seriously. So there's this big capital gap that we identified, where institutional investors would like to be a part of this space, but they can't do $5 million tickets. They need $50 million tickets. So how do you start to build that on-ramp for more experienced institutional investors? It's track record, it's pipeline, and it's intermediate products.
Thank you. Suma, can you share with us a couple of investments that you've made, specific companies, what they're doing, sort of bring it alive for us, who you're investing in and what, why? Yeah.
Sure. So as I was saying, I cover the Asia market, so I'll give you a couple of examples, both in Asia. One of our investments is, we are private equity growth investors, but we do have a small allocation that we're allowed for venture capital. And so one of our earlier stage investments is in an off-grid solar company that's based in India. And what they do is really interesting. They provide solar home systems on financing to rural households within India. And it's a challenging market for various reasons. The market itself, there is certainly an energy deficit, but there's also a government that's announcing that it's going to provide 100% electrification without actually providing it. And so there's a disconnect between what the market actually is and what the consumer thinks is going to happen to the market. That's one issue. There's the other issue of the space itself, solar home system financing being newer within India. And so there's not as much private equity money going into this specific industry within this region, although there's a lot going into other regions. And so what they do is provide these larger solar home systems compared with, so the other regions where there's huge off-grid solar is in East Africa, and where most of it is solar lanterns, smaller 10 watts, 20 watts systems. What this company does in India is provides larger wattage systems between 50 to 200 watts, provides TVs that go along with the panel, provides electricity along with mobile phone charging units, as well as they also have fans and a cooler, as well as water purification. But the other unique aspect of what they do, which is where we come in, is they provide a lot of these products on financing. And so that's the financial inclusion component for us. And it's a very interesting model because it has a mix of a consumer durable company as well as a financial company. So whether you think of it as a FinCo, as an OpCo, how do you think through the operations? What portion of it is microfinance? What portion of it is entirely product driven? And where do those two meet? Because they are completely interrelated. You cannot split them up. But then how do you work with that sort of tension is a lot of what the company is working with right now. And it's interesting because they're at a earlier stage than what we typically look at in a market that has immense scale. And some of the operational issues down in the weeds are very interesting. So if that's enough?
Yes, that's perfect. Amara, could you talk, you said you had 100 plus impact investing portfolios. Could you give us a sense of a couple of them, what they're actually investing in and what kind of impact they're looking for?
Yeah, impact investing products on the platform. I think we have about 8 model portfolios out of those that the clients can use and advisors can use in different platforms. So an example I'll give is we have a number of clients, and I think generally there's been a trend in the last few years of clients really interested in community-based investing. There's often lots of things that you can do on the private market side. Accredited investors and larger investors have access to lots of interesting community-based investments there. But on the public markets, if you're just a regular person with a brokerage account, what can you do to invest in local communities in the United States? So one of the really interesting investment opportunities on the platform is community capital management, which invests locally in healthcare, schools, local infrastructure in different communities across the United States. And that is exactly what our clients are looking for. As a counterpart to what the private markets are doing, which is deeply impactful and really important, this is an easy opportunity for regular retail investors to make these types of investments. So that's one example. And then on the very other side of this, and I'm sorry I'm going to be annoying and not tell you the name, but we're raising a private equity fund right now that is on the private market side, emerging markets focused, a really large institutional fund, and really is proving the point that our investors are really interested in impact investing. One of the challenges at Morgan Stanley, because we have such an institutional rigor, getting smaller emerging funds on the platform is difficult. But for our clients who are really interested in investing sustainably, they're looking for 100% of their portfolio to be in impact investing. So what do they do with that 10 to 20% alternatives sleeve that they have? So we're now bringing out more and more products on the private market side to really give them those options to fill all parts of their portfolio, not just the public, but the private side as well.
Thank you. So, we often hear in impact investing all the great successes that we have, but this is an emerging field, right? We're learning a lot along the way, and some things work and some things don't work. So I wondered if you could share with the group, all of you, what was a failure that you had, either on the impact side or on the financial performance side, or both, and what did you learn from that, and how did that shift your approach in terms of impact investing? Who wants to start? That's a tough one, so you'll start, Jason?
Because you told us you were going to ask.
I did. You're telling my secrets.
I mean, I guess I'd say two things. I think there's a whole bucket of things that were just either not commercial or hard to raise money for. And so we've definitely had a few things that we thought were going to be really great investment areas for investment that turned out not to be, or things that funds we developed, companies we were working on, we thought it'd be easy to raise money, and we either just stopped or we had to pivot to something else, right? So there's a ton of those that talk about why things fail in fundraising, which I think many, many, many more things fail in the fundraising process than not. And then my experience with Generation and a couple other managers is that when you kind of hit an inflection point, either on track record or impact, mostly around returns rather than impact, or just scale. Once you get to $500 million, or once you get to $1 billion or so, unless you have really bad performance, things just tend to accelerate pretty quickly. So there's just this there's 5 to 10 years of building a product that's pretty shaky, pretty hard. But I will give one specific example of something that really succeeded on the impact side that didn't succeed for us on the financial side, but succeeded for our partner. So I mentioned some work we did around green infrastructure. We put together we did a big report, 2 reports actually, with NRDC and the Nature Conservancy on stormwater credit trading. And we developed a stormwater credit trading development company for Washington, D.C. It's all public information. Prudential Social Investments backed it. It was a kind of an innovative debt structure, innovative partnership between the Nature Conservancy and Encourage. And actually, it really did work from a from an impact perspective. We've developed a bunch of credits. We've preserved a bunch of land. We've kept a bunch of stormwater out of the Anacostia watershed. And we've made money. We've actually generated reasonably interesting returns, but not interesting enough returns to be commercial. So either too much risk or not enough return, however you define commercial returns. And so what we basically said to TNC was, look, it doesn't make sense for us to do this because we're a purely commercial organization. And even though we get grants and contracts now and then, we can't sustain the amount of human capital it would take to keep doing this. Do you want it, basically? And so we negotiated basically a deal where Prudential kept funding it because Prudential was happy with the impact and happy enough with the returns. I mean, the deals were making money. And TNC was really committed to the returns, and so we've retained an interest in it. We're still on the board of the company. The partnership works. There's impact. There's return, but it's just not of the scale that makes sense to us. And to me, that's kind of, I don't think we're ready to, write a case study or something, but I do think it's a really interesting story and dynamic that for different people, different things are success.
Yeah.
And for us, we just had to move on.
Yeah.
But for TNC and Prudential, they thought it was a great success. And so, eye of the beholder, I think, determines whether things succeed or fail a lot in this space.
Suma.
So from our perspective too, I think in terms of failures, in the earlier stage investments that we look at, I think fundraise is one big part of it, especially for companies that are still proving out their concept, that haven't yet proven that they have a viable model, that still has a cash burn when it becomes even more important to raise capital. But that's one part of it. The other big portion that we see, especially in private equity, is it's just people, whom you invest in, who is on the leadership team, who is on the chairman's role, who's driving the efforts at the company, and whether their interests are aligned, whether it's impact focused, whether it's financial returns focused. To give us all a specific example, I think one would be, again, this was a microfinance institution that is based in Colombia, and one of the issues that we've always dealt with, having been in the industry since 2008, when most of the MFIs that were set up were started by foundations and nonprofits, is having strong controlling shareholders. And so even if on the impact side, what we've had is a very positive story, where there has been increase in the borrower base, increase in the types of products that are being offered to them, the ability to start taking deposits as a financial institution. However, from a financial standpoint, even with the company operating well, what you end up with, if you have a strong founding shareholder whose interests may not be aligned, is, again, the difficulty in exit. And that's one of the issues that you see, I think, broadly in impact across a lot of funds and regions. And for private equity specifically, one of the key learnings that we've had with some of these financial, not really star performers in our fund, I think one of the lessons that we've learned is just a better assessment of people and how we systematically incorporate that into our due diligence process, how we systematically incorporate that into our negotiation, the types of rights we ask for, whether we're minority or majority shareholders. I think that is all a result of the experiences that we had from our first two funds.
Thank you. Rob, what do you have to add?
So I'll tell a specific story. It's one of the first investments we made at a closed loop fund, which is a debt fund. We do recycling projects across North America. The context I'll just set is it's what's called a plastic recycling facility, PRF, or we would call it a PERF. And there are lots of kinds of plastics. There's your plastic water. There's PET, which is what your water bottles are made out of. There's HDPE, which is what your laundry detergent bottles are made out of. Then there's sort of everything else. And in most communities, when you put your recycling in a recycle bin, your ones and your twos get sorted and go to market. Your everything else, they call it a mixed bale, or your 3 through 7s. Well, it depends on the local market. And is there someone who will take these mixed bales? So we financed a PERF in the Mid-Atlantic region that would buy those mixed bales and further process them to create more value to be able to build the markets. And the idea was they would source up and down the East Coast and build a market and pull through more of these mixed bales that were currently basically going to landfill or being exported. Most of the mixed bales at the time were being exported to Asia and specifically China. Then the Chinese government decided to ban all those exports and destroyed a lot of the market for a lot of that material. And that perf basically sort of got stuck in the middle of it, and has now, the other people who were backing it basically decided to stop throwing money into it, and they shut it down. They looked for a seller, and just a couple months ago, they announced that they were going to scrap it and sell it for parts. So from like a failure perspective, I think that's pretty clear. I think, the reality is it was trying to develop a new model that could be potentially game-changing for a really challenging part of the value chain. And we were in a unique position because our investors had clear expectations with us that they wanted more of that risk, right, and more of that impact. They're willing to take on more of the risk for more of the impact. So the big, we structured it in a way that actually kept us whole and through the process. But optically, it's not a great story to tell, especially from a track record perspective. But I'd say that the big lesson in that process is really clear expectations about what kind of risk you're taking on and what kind of impact you're hoping to generate and what kind of returns you're trying to generate with your investors and the people you're managing money for. And if they have clear expectations about that risk going in, they're not going to have a problem on the other side. But if you sort of had some hubris in that process or you oversold what you were delivering, you do have a real problem.
Thank you, Rob. Humera.
So I'll answer this question again a little bit differently. One, because I've been at Morgan Stanley for 5 months and have not yet had the opportunity to fail too hard. But two, because on an open architecture platform, failure looks different, right? So we have a lot of products. If performance is, the track record hasn't been good for a while, if impact and transparency isn't there, we can take something off the platform. It's a different level of investment that we've made into these opportunities. But what I think is also interesting is, to Tensie's point earlier about the evolution of impact investing and where we were and where we've come, I think the way that especially the Investing with Impact platform at Morgan Stanley has evolved is particularly compelling. So we started with a lot of negatively screened investments. There were just a lot of restriction screens based on faith and alcohol and guns, et cetera, and have moved in the last few years more to ESG integration, where we are now actively looking at managers who are thoughtfully and thinking through the environmental, social, and governance risks as well as performance indicators in the investments that they're making. And now even more so to thematic and more impact-oriented investments where there's specific themes that clients are interested in that now fund managers are starting to fulfill that appetite for. And I think at the same time that the market is evolving, our own process is evolving as well. So recently we had a big meeting where we added additional questions to the due diligence questionnaire, not just for the sustainable investing portfolio, but for the portfolio at Morgan Stanley at large. So questions about women on board and leadership or minority ownership and leadership, benefits at the organizational level, the types of relationships with investees and beneficiaries and local communities. These aren't questions that were asked before, and as we all get smarter on what it means to be sustainable and to make an impact, I think both the pipeline of investment opportunities and the way that they're being diligenced continues to evolve.
Thank you. So in listening to all of you, the lessons learned to me sound like the same lessons or similar lessons that you would have in any investing, right? So you need to find the right people. You need to deal with the fact that it's difficult to raise the funds. You need to set expectations. You need to manage external risks that you weren't expecting, right? All of these sets of issues are ones that people need to deal with no matter what the type of investment. But in impact investing, it's more challenging because there's less of a track record, it's high risk in a way, it sounds like a bit what you're saying. Yeah. Well,
impact investing is harder because you're held to a double standard.
Yeah.
You have to do both the financial returns and the impact returns. Right. Financial first investors get off easy, right? Yeah. They only have to do one of it.
Right. So let me follow up with my last question. We're going to open up to the audience on that, which is, there is and you alluded to this, Jason, so I'll start with you. There is a perception that impact investors are focused more on the ESG impact than they are on the financial returns, that it isn't necessarily possible to have everything all work together to be held to that double bottom line or triple bottom line. And in some cases, maybe investors actually will take the lower returns, financial returns. So I wonder if you could talk a little bit about your experience with those sets of issues, balancing the impact and balancing the financial, and how you tackle that. So, Jason?
Yeah, I mean, maybe I'll take one big step back because it is a business school.
Use your microphone.
Thank you, Rob.
Thanks, Rob. I'll take one big step back because it is business school and say that there's a whole part, in spending the last kind of 15, 20 years in capital markets, there's a bunch of religion in capital markets generally, and whether it's portfolio theory or, expected returns from different asset classes, that is just a bunch of hooey. And everybody who works in capital markets knows it, but it's just kind of, you need some kind of structure and some kind of framework and some expectation setting for people to create asset allocations and make investment decisions and say, well, emerging markets PE is, 15%, beta and alpha, and it's, good investors are good investors and good stock pickers are good stock pickers and bad stock pickers are, having them public and private, and it's, you just have to live within that framework, and there's no reason to fight the machine. It is what it is. You're never going to convince an investment consultant that their model sucks. So all that having been said, then a lot of this is game playing on both sides, right? So if you're doing an emerging markets private equity investment, it has to pencil out to 25%. Everybody knows how to make a model look like it's going to generate 25%. It's not that hard. Same thing we did in venture in the 90s. Right? And you learn how to do it when you're an analyst, and you do it for 60 years. But you'd better believe that you have a chance to hit that number, and you better be willing to stand behind that number, because once that person gives you their money, you're then a fiduciary, and you have to give them their money back at that rate of return, or you've failed. And so I think there is a certain rigor to financial return that is just it's non-negotiable. And if you make money for people, you get more money, and if you lose money, you don't get more money. And if you want to be in money management, that's capital markets, and that's okay. And I think it is possible to be successful in capital markets and not make money for people. But what do they say? Eventually, the tide goes out, and you figure out who's wearing whatever. It's just whatever you say. And, there's cycles and all that kind of stuff, right? But I do think that, that's important. You can never forget that ultimately someone is giving you their money, and you're accountable to deliver a return that you told them you would deliver. So in that context, I think impact is something, and by the way, I think there's a huge market for investment products and a huge opportunity to make investments that are not trying to achieve a market rate of return very intentionally, like the deal we did with TNC, which, just to give you context, is 8% return, which is a great return, but there's risk, and so it could be 0. It could be 20, but 8's the target, and whatever. So I think if you go into the world and you say, we are going to deliver you this return that's less than you can get somewhere else, we're going to give you more impact. What the market hasn't figured out is how to hold you accountable to that impact, because most of the impact right now is kind of hand waving and stories, and the industry is just not mature enough to say, we made very specific commitments to Zoma, which is the family office we got our money from, around employment and other metrics around our seafood strategy. And they hold us accountable to it, and we're trying to report on it. But it's just so much easier to say, did the company make their quarter? What's the year on year? revenue increase, EBITDA. It's just easier. So I think, so three things. One is, if you're going to be in the investment business, you have to deliver investment returns, whether they're concessionary or commercial, whether you believe the hooey or not. That's how the market works. The second is, if you really believe in what you're doing and that it's not going to generate market, that's okay. Probably harder for you to raise money, but ultimately you'll be more successful over the long run if you're just honest about those expectations. And I think I use the Malloy Fund as an example. I don't know if they're going to be successful, but they raised $20 million, which is a lot of money, to do really impactful small deals. And no one would have believed them if they told them they're going to generate 25% returns. And I think they'll be successful personally. And then the final thing on impact is there's a lot of courses and structures and impact management, and I think that's all good and all right, and it's all going in the right direction. But it's just really hard for even you to hold yourself accountable to that. And that, I think, is a huge there's a lot of reality distortion going on around that side, which is, I think eventually will fix itself, but it's like a 20 to 30 year problem. You need track record, you need experience, you need multiple funds, and you need systems and metrics. And so that's kind of up to you, how much integrity do you want to deal with that with, and it'll be tempting to kind of wave your hands, and you got to try not to, I think.
Thank you, Jason. Measuring social and environmental impact is really hard, and it's expensive too. People don't, we don't have a lot of track record of figuring out how to do it or how to do it in a way that's not expensive. Right? So, Suma, what are your thoughts on this challenge?
Well, I think from DWM's perspective as return-first investors, there is, the way we look at it, or at least me too, especially when you're thinking about what types of different capital is available and where it fits in, going into that entire puzzle. I think the problem beyond that is just, what's the problem you're trying to address, and what type of capital would be best to address it at that point in time. So, for example, a lot of times when we're trying to prove out a concept, if there is earlier stage industry that there's not much institutional capital going towards right now, because again, there is no track record. But if there is a proof of concept that may initially need some kind of concessionary return or a risk-sharing structure to prove it out, and then build it out at scale, turn it into a commercial investment, then I think there is potential at different points in time for different types of capital to come in. So I think depending on where you are, what type of investment you're looking at, it depends on what type of returns you're seeking. Having said that, from DWM's perspective as a return-first investor, return-first impact investor, one of the big points that we see overall in the impact space is, to Jason's point, track record. There's some amount of track record, but clearly not enough yet, because there's just not enough history for potential LPs, potential investors, anyone looking to get into this space, because you go out there and you say, well, it is possible to get return-first investments, to get the target IRRs of 20, 25% that are typical. Risk-adjusted returns is another term that comes up a lot. How do you know that it's a risk-adjusted return? So it's all that, I think, ultimately boils down to a question of track record, which partly will come with time, and partly with a few impact funds hopefully finishing their exits around now, having DPIs, CVPIs, all of that's put up in the benchmarks that proves that it is a viable investment opportunity. And then the third part of that question on the impact side of it, as the industry has evolved, to Humera's point, from negative screening towards trying to incorporate it a little bit more, and then now we're at a point where we have yet another alphabet soup. There's all of these different ratings that we're looking at. There's GEARS, there's PRI, there's IRIS, all of which are good and all of which serve a need. But from a true impact measurement and reporting quarter on quarter, the way we want to move towards more and more is to incorporate your social or impact data along with your financial decision making. So instead of thinking of it as two very separate and parallel, unrelated streams that go alongside each other, there is a way in which you can think about impact metrics and financial metrics that complement each other can be incorporated into the entire life cycle of your investment. And maybe that's one other way to look at a stronger impact assessment and an easier way to monitor it.
Thank you, Suma. Rob?
So, the impact investing has become a marketing gimmick, right? I think that's part of what Jason's talking about is like people are, it's super hot right now. People think they can raise money around it, but impact is in the eye of the beholder. I know one very popular impact fund that's sort of Silicon Valley style. They made a huge investment in a company that has nothing to do with impact, but happens to be based in Oakland, which is like kind of a low-income community. And they're very, very proud of it. Their investors are very, very proud of it. It's their, it's in the eye of it's their perception. It's what they think is important. And, that will, I think, continue forever. I've worked in environmental sustainability for 20 years. We're still arguing about what's sustainable and what's not. We'll be arguing about what's impactful and what's not as well. I think one of the big things that's interesting about impact investing is it does take, you got to hit some big home runs. We need some more unicorns in the impact space. We need some funds that generated really high returns. It takes 10 years to do that. So we're at the 10-year mark of some of the original funds. Many of them didn't make it this far. Some of them are getting into Fund 2, right? Like to get onto Morgan's platform, you need to be at Fund 3, really, and you have to have that track record. I mean, no offense, right? But like to get on, if you're talking about what's on Morgan's platform today, there is a question around where is the impact there, right? Because a lot of these really like impact first guys can't even, it's like not possible. Even if they did have financial returns and were going to make tons of money, the criteria is set up in a way that like emerging managers don't get on Morgan's platform, UBS's platform, JP's platform. So it's that's where the scale is, and when we'll start solving this problem around what's impactful and what's financial return, and is when you start unlocking that large scale institutional capital. But it takes a long time, and we're just at that first chapter kind of transition point.
Yes, they'll put a Fund 1 of KKR, GPG, or Bain on the platform, which to me is problematic, but we're benefiting from it, so I'm fine.
So Humera, would you like to address these and also to give the final? You get to have the final word here before I open it up.
Great. To Rob's point, it takes a lot to come onto a Morgan Stanley platform. We have a fiduciary duty to our clients who are retail investors, and we need to make sure anything that comes on passes the muster of everything else coming onto the platform. All of our impact investing products and solutions have to, again, go through the same diligence process as anything else coming onto the platform, all of the traditional investments. There is no concession on financial returns on the platform. Everything coming on is equal to its benchmark or comparative. I think the challenge is that institutionally then we can offer things that are at Fund 3 that have a big name attached to them, or that have some other larger relationship that makes a Morgan Stanley feel comfortable to give this open platform to 16,000 financial advisors that are managing $2.5 trillion in assets. So it takes a lot to get there, and I think my goal in being in this position is to see that move, is to see the institutional capital be able to invest in organizations that are doing really impactful work like these three. And then to Rob's other point, definitely from our perspective at Morgan Stanley, impact measurement is based on the eye of the beholder. It's completely focused and customized on the client. Clients care about different things. They weigh things very differently. The ways they think about issues that they're concerned with versus the things that they actively want to manage is completely customized by person. And so right now, actually, I'm working on a project that we hope to launch next year for across Morgan Stanley's platform to be able to measure impact, like Suma was saying, right alongside your financial returns. You can measure your impact in your portfolio. So you see what the financial returns were, and then you see how your investment performed against your benchmark in climate solutions or gender diversity, or against a negative screen that you had for alcohol or weapons. So it'll be completely customized for clients, but again, that doesn't help us get to a place where we can bring scale to this and bring it all together. And I think that's the big challenge with impact measurement, is that there is so many different ways of doing this, and how do we get it all to be feeding into a larger group pool of information that we can all leverage.
Well, thank you for a terrific panel discussion. We're going to and let's open it up to questions. And please identify yourself when you ask your question. Yes.
Hello, my name is Pablo. Thank you for the panel, very interesting. So I actually have two questions, and they're very different. But the first one is, I want to hear your guys' thoughts on what causes and sectors are getting the most, or having the easier time raising money. So like in the company side, like be it recycling or be it fisheries. And then which ones are having the hardest time. So basic sectors that would have a really important impact in our world and our society, that for some reason or the other are just not raising money. So that's the first question. I'll ask the second one after.
All right, let's do the first, and then we can come back to you for the second one. So who would like to tackle that?
I mean, I guess one thing I'll say quickly is I think these things are pretty cyclical, and fast following. So you have a couple of successes in the sector, and people pile in, and then returns go down, or too much capital, and a big failure, and people move on. And so, one just positive story is that there's quite a few funds and managers I know of that are raising now a lot of money to do things that are more real asset and project finance oriented around kind of ag and water and energy. So that sector seems to be maturing to a place where you've got a couple funds out there that are pretty scalable and successful. That's one on the side.
Good. And your second question?
Oh, so my second one
I
is.
didn't come up with one that needs money. What about one that isn't the sector that isn't getting funded?
I mean, I think it's very region specific also in what we do. I mean, I was saying, sorry, that I think it's very region or even country specific. So forest specific, the example I was giving earlier, if you look at off-grid solar, you look at some of the off-grid solar companies in East Africa, and there's a lot of money going in from institutional investors. I mean, raising rounds, Series B, Series D rounds without break even yet, to the tune of $60 million, $100 million. And at the same time, if you look at it, off-grid solar anywhere else, say in South Asia, because there are a few companies that are doing very similar things, but not yet proven the concept in that region because the energy market's very different. So I think it also depends very much on what place you're looking at one point. The financial inclusion space, I mean, in India, you're seeing IPOs of microfinance industries. You may not see the same thing anywhere else. People may be struggling to fundraise. So yeah, that's my response. Thank you.
So,
Yeah, actually, let me take some others, and we'll come back to you. Other questions? Maybe we'll have to. Yeah, in the back.
My name is Ravi, and my question is, in terms of the clientele, if you can review that again, for, let's say, the accredited and qualified investors, who's driving these investment flows to do impact investing? And institutionally, what are the better institutions that are better able to execute? Like, for example, you could have, on one hand, a very large financial institution that may have run into some problems with their own issues, but then offering these types of investments. Is there a way to be more of an independent RIA or something like that that can bring these investments to different types of investors?
Humira, I know Morgan Stanley has done a fair amount of research on investors and trustness. Do you want to share some of that?
Yeah, sure. So on the institutional investor side, I think we see a lot of faith-based investors, foundations on their endowment side. They're really leading the way and taking the most risks, and then we see other investor of institutional quality follow.
Okay. Anybody else want to add to the question?
From our perspective, we see a lot of institutional investors who are in all of our funds. We have one or two faith-based as well, and development financial institutions. That's another big one, I think, in our sector. So a lot of them from Europe. The good news now with the U.S. development financial institution, which hopefully can start making more private equity investments. Maybe that will be another positive that's coming out of here. But so far, DFIs from Europe have been leaders.
I would say, in the U.S. right now, there's a lot of the impact investing noise comes from kind of the high net worth and family office community, and there's like conferences and they love to talk about it. I think there are because those guys can't really get what they want from an investment bank, they're starting to look for sort of their green sleeve. And there are RIAs that are kind of making small they're getting a handful of clients, then they're building a business around, I can help you do that because you're going to keep your money at the bank, but I can help you do a green sleeve in some way, either through that firm or, they have I've seen their clusters are 5 or 6 clients kind of business, and then they have other stuff they do too.
Thank you. Where's another? Yes, over there.
Hi, Matt Ramondi. This is coming from something that Suma mentioned, just about the importance of management when you're evaluating these companies. And I was wondering maybe if you could talk a little bit about what you are looking for specifically and how that might differ from kind of more of a traditional investor, in your case, kind of a private equity investor.
Yeah, I think actually it's very similar to how a traditional investor would look at it, with the added layer of intent for impact. So trying to assess if we're looking at the leader or the CEO or the chairman, whoever it is at that point in time, if we're trying to assess whether they have, one, the ability to execute on their idea, the intent to deliver the mission that the company is being set out to do, and very important, and probably more important, the senior management team that they've set in place, whether they are independent, whether they can execute actually on this mission. And so I think a lot of times the assessment lens that we use during our due diligence, during our value creation period, is very similar to what you would see at a private equity fund, with this added dimension of impact.
And I would just add one thing, which you actually said earlier, which is alignment. And I think that the one area that tends to get problematic for impact-oriented companies is if the investors and the management are misaligned. That can happen in a regular company too, but around impact and about where you're going to make sacrifices, where it's okay to cut corners, where it isn't, what are different lines, because those are difficult decisions for a company, and sometimes it comes down to long-term and short-term, and there's not always a great answer, but I think misalignment around the impact in the context of the financial outcomes is very tough to figure out.
Thank you. Yes.
Steve Friedman, NYU Wagner. So impact investing is very hot. We established that on the panel. Another hot topic is blockchain these days. So any thoughts on the potential use of blockchain technology for impact verification and measurement?
I can take a quick stab at that, because being in financial inclusion, we know that the next, not as much yet on blockchain, but the next step we know is a lot of fintech, but broadly digital. How will our portfolio companies take digital technology to essentially drive efficiencies, use alternate delivery channels for growth? And so we've started discussing blockchain internally just to try and get a sense of what that is, to try and understand from a fintech perspective what we can do. And obviously cryptocurrencies is not the way we are going with blockchain, but we are thinking more in terms of security, in terms of digital identity, actually, I think is one big area in our sector where we're seeing blockchain being used the most. There's at least 3 or 4 companies out there right now trying to work specifically on the digital identity issue using blockchain solutions.
And we're seeing a lot of blockchain and tracking and traceability for natural resources.
Yeah. And just on that last point, one of the things that I find interesting is that for people who don't really understand blockchain, they think that magically, by putting the blockchain in place, then the product becomes sustainable as it runs through it, right? But actually, it's garbage in, garbage out. So one has to really understand what is happening in terms of impact. Let's just say you're talking about sustainable sourcing and supply chains. What, you know, if the forests have been cut down unsustainably and you plug it into the blockchain and it's transparent where it comes from, it doesn't really help you with the sustainability claim. So just to, you know, because I hear people, magical thinking around blockchain. So, yes, here.
So this is Ami.
If you press the button, yeah.
Hi, my name is Ami, and most of the investments which happen in this sector are debt-based or debt asset class. Is there any specific reason you think with the impact ventures that they are lesser private equity or VC investments?
So that's not actually true for the sectors we work in. I mean, I don't know if it's even true for micro. You guys do a lot of credit, right? But for a lot of the sectors we work in, and environment and kind of real asset type, you know, natural resources, it is mostly equity. And in fact, credit is the problem. But I do think in some other sectors like microfinance, there's actually probably better access to credit and less equity.
Yeah, I'd say in our...
And why that is, I have no idea.
Yeah. I mean, I think part of it is just the industry, where, you know, debt is your raw material in financial services. And so there's a lot of, when investments started out in microfinance, a lot of it was debt-based investments. And also when you're exploring into new geographies at any point in time, it's a smaller hold period, more guaranteed source of payment. You can track their cash flows. So less risk. I mean, it just, again, comes down to risk-adjusted return and the risk-return spectrum. And then why private equity, one part of it is clear, the returns, the hold period. In microfinance specifically, we've seen both now. Private equity has grown significantly. In our AUM, I'd say the split is 2/3, 1/3, 2/3 being debt investments and 1/3 the private equity.
Other questions? Yes, Jamie.
Hi, I'm Jamie. Thank you very much for coming today. My question was, you mentioned a little bit the trouble of finding large institutional scale deals, and then you brought up the 2 recent funds that have really launched kind of mega impact funds. I was wondering what your take on whether that's going to lead to, or the potential risk of kind of greenwashing, and what that means for the impact sector as a whole.
Go ahead, Jason.
I have strong controversial opinions on the matter. No, I mean, I think it's a really, I do think it's a really great thing to have these mega funds and mega managers come into the market. And I'm kind of joking, we're benefiting from it for a reason, is they have access to massive amounts of capital and not enough deal flow. So if they're interested in your sector and you can be a partner, it's great for everyone. They're going to the GICs and CalSTRS of the world and getting the capital, and they're investing it in transactions that folks like us are sourcing and diligencing and then partnering with to manage. That's great. I think the challenge is that the fundamental business model of these large firms, which I know from Generation, which became is a $20 billion firm right now, you've got to get money out the door and you've got to create new funds, and that creates 2 problems. One is short hold periods, which Generation is trying to solve in a couple ways, but it still is a challenge for their private equity vehicle. Short hold periods are fundamentally not aligned with positive social and environmental outcomes. I wouldn't say they're inverse, but they're pretty close. Number one. And number two is because you just have to get large amounts of money out the door, and I guess I won't pick on the specific fund by name, but there is a fund out there marketing themselves saying to some people, hey, it's an impact fund, and to some people, don't worry, we're just doing the same growth equity deals, but putting the ones that have impact in that fund. Now, that's not cool. That's not okay. But they're going to get away with it because they're big and because people need to deploy capital to them. And if you're, again, GIC is a Singapore, if you already have a $5 billion relationship with that firm, you're going to stick a couple $100 million in there and just hope they don't screw it up. Like, you just need to get money out the door. So I think it's a big opportunity to help these firms get it right. And I suspect that they'll do private equity, then they'll do debt, then they'll do real assets, and they'll build exactly the same capital markets infrastructure they've built for mainstream capital. And eventually, in 30 years, in 50 years, it'll all merge together, it'll all be one thing, and people say you're insane if you don't integrate sustainability and be more long-term. But I mean, that's kind of a rosy version of the future. In between, I think we're going to have a lot of really bad screw-ups, and if folks don't know about it, I think we've already had one. So Abraj, which anyone who does emerging markets kind of will know, just blew up. We will be hearing about Abraj for the next 30 years. Like, every time we go into a meeting about emerging markets.
Give people one sentence on what
you
it was.
Should.
No,
you
go ahead.
Who wants to take a shot? I don't even want to try to characterize it because I don't really know what happened, but it's a large manager in the impact space that is being sold off in pieces because there was allegations of fraud. I mean, I don't know.
Use of capital.
And I don't know what happened, but all I know is we're going to hear about it forever, and that's just going to reinforce people to go more into these large funds that feel safe. And so there's a real opportunity there to close the gap because they're able to raise capital. I mean, to me, again, just to say the absurdity of saying like a fund one with a new team at a big place has no better chance of doing well than a fund one of experienced people with track records at a new place. Except for the fact that people see the name and so we're like, well, forget it. We'll just partner with them. And they're happy and we're happy. But there's going to be a lot of things that fall in the middle. And I think we're going to have a really bumpy road. And the last thing I'll say is I do think that will start to change also again, and maybe it'll be 5 years, 10 years, 20 years when you have kind of impact native platforms like Generation getting to 20 billion and going on its third and fourth product is a big deal. Because then you're starting to get in the range of like some of the big hedge funds and some of the PE managers, Vision Ridge, as some of these firms get big and they create a private equity product and they create a debt product. And you start to see that it's possible to create kind of an impact native platform that gets to a couple $2 billion. Then I think we'll start to see that convergence. And for that reason, it's really exciting, but it's also a little scary because there's going to be some very public disasters.
Let me take two more. Yes, Greg?
But on that, I'm kind of a comedian.
I hope people don't mind if we stay on this topic. Thank you, everyone.
But we'll let someone else answer it.
But just kind of related to sourcing. I mean, what are these mega funds, and what are it's hard. It sounds like it's already very hard to find deals. In my internship, I saw that. So I mean, where is this money going to go if we're talking about kind of commercial returns? How does sourcing improve, and are the banks really involved or aware of these types of deals, and how do you guys view those challenges?
I think those mega funds are going to have a real major problem, and that's where the greenwashing comes in, right? They're going to have to squint to find the sustainability impact, and we based the company in Oakland, so it counts, right? But at least we got the money out. But at the end of the day, everyone's investing in those funds because of the marketing. Bono told me to do it. That's a great marketing campaign. I wish I could do that. That I think they'll be judging the returns first.
Day, Rob.
Yeah, one day. I'm working on it. They're going to end up throwing a lot of money in sort of quasi-impact directions, but the ultimate goal is to get the money out the door and generate a return. But I think like Jason said, the value of it is building that marketplace and showing it's possible.
Other questions? Yeah. Oh, yes. Sorry. Oh, hi. Come on.
My name's Alex. I was wondering what guidance you have for navigating conversations with stakeholders or organizations that aren't exactly receptive to impact or things that your organizations are doing. What tips do you have for illustrating value? How do you make the case? How do you convert someone?
Yeah, I think to the points being made, it helps that we have big names and institutions like the ones that are now getting into this sector giving that message out, because however they're doing it, that hearing that message from a traditional private equity manager who's now raising their 7th or 8th fund is a very different conversation than hearing it from someone else. I think there's a lot of data now that shows the track record, the fact that concessionary returns is a myth unless you want to be in the concessionary space, and especially if you consider risk-adjusted returns. I mean, if you're looking at, for example, climate-resilient infrastructure, that's a very long-term value that you may not see in 5 years, but in 50 years, that's a completely different risk-adjusted return than you'd see for other investments. So performance, the people they're hearing it from, and I think also the diversity of investment opportunities. For me, as I talk to clients who are, it's a family where the parents don't really know what this is, but their kids really want to do something in this, and they need to learn because they want to move the assets over to their kids. The conversation then goes to, well, you can really fill all asset class allocations with impact products. There's enough diversity of products out there now for you to consider these across whatever you care about.
Any final thoughts from any of you before we close?
Are you talking about like activist stakeholders or? So we're dealing with an issue where, this ocean plastic thing is really getting a lot of attention, and there's a fracturing happening within the space. So a year ago, nobody was talking about this thing, and we were the only people there with the Ocean Conservancy and Encourage, and now everybody and their mother is in there, and you have everybody has a role to play. And so if I'm a campaigning organization working in the ocean space, what's my contribution to the biggest issue in oceans right now? It's going to be a campaign, which will create sort of pressure in different ways, and how do you drive that to a productive direction? And we've seen this happen in the climate space, right, where there became essentially infighting with my solution's better than your solution, it basically politicized the system. So we're seeing that. I see that in the next year within ocean plastics, right? Right now everyone's kind of for it, but there's sort of two pieces to it. Let's reduce our way out of plastic, or let's recycle our way out of ocean plastic, or waste management our way out of it. And the reality is it's a both and. There's no silver bullet to any environmental issue. Anybody who tells you otherwise is, selling an agenda. But how do you sort of frame what we're doing as driving one piece of the solution? It doesn't let companies off the hook for the other pieces of the solution. But I think we're in. It's something I'm working on very actively right now. And it's going to be tricky to see how it plays out, because at the end of the day, people are chasing money, and there's not a lot of interest in the outcome, even when you're an environmental NGO, if your funders are telling you to do something.
Sure.
I'll say three quick things. One is I don't want to assume everyone here believes that impact investing is this great, wonderful thing. So I would say if you are skeptical about it, I think there's an increasing amount of research and data that shows that you can have both and so I'm on the board of a nonprofit family office network. We're doing a lot of work with Cambridge Associates right now, which has published a bunch of data with the GIN and other places, just to start to give people comfort that actually there is becoming data available to show you can do both and there's good managers and bad managers in every sector. But I think that's something, if you're skeptical, is worth looking at. And also, if you're maybe trying to convince someone that this is a really important market, I completely agree that having kind of big names and brands come into the space gives it a veneer of credibility. And then if you can go to the next level and go find data and examples to show people, to say, look, this is a both and. It's not provable. Nothing is provable in finance, despite what people say, but there's enough data to get people, I think, over the credibility threshold, which there wasn't, 10, 15 years ago when we were starting Generation. It was really a much more difficult push. And then the final thing I'd say is, if you come more from a nonprofit or, a social environmental impact bent, which I did when I originally came into this space, I would be really excited about being at a place where you can, like a Nature Conservancy or even a Calvert or places like that, where you can build products and make investments that are using capital markets to have an impact. And I do think sometimes, especially at a business school, having gone to one myself, like everyone gets excited about the market and commerciality and scale, but there are really exciting things you can do with your life and your career and your money that are super meaningful, that aren't going to get you the highest possible risk-adjusted return for that asset class. And that's a massive opportunity, especially as we see generational change, shift in wealth ownership. That is happening right before our eyes right now. And so I think that is something that, look, the mainstream asset owners, and they're never going to go to that market, and it might be easier to build something really interesting.
Thank you, Jason. So just to sum up, I think what we've heard from this panel is that impact investing is a great space to be creative, to figure out how to have your own personal impact, right? Because you all are learning as you go along, solving for these challenges as you go along, thinking about the broader ecosystem, thinking about things in a much more complex and sophisticated way than, as you said, Jason, just what my financial return is, right? And doing that, it's challenging, but it's also fun, right? I mean, I think I heard from all of you, yes, I heard it underneath, yeah. And that, it's an opportunity to design solutions using finance as a tool for societal ills, really, as well as opportunities. And that's one thing I think in finance often we're putting everything in a risk frame. But for me, what we hear from impact investors is how we think about this in an opportunity frame and how we can really contribute to society and make money while we're doing it. So thank you so much. Thanks all for being here tonight. And I know our panelists will stick around for a few minutes if you want to come talk to them. So thank you. Thank you very much.